Welcome to this practice activity opportunity. Before moving on to more complex content, I ask you to go carry out 3 tasks for each of the 2 lessons we just finished. The content of this practice opportunity can be downloaded as a PDF file as well, so that you can follow along. The PDF file contains the solutions too. Regarding the main features of fixed income securities, make sure you understand the basic features. First, define what distinguishes bonds from equity instruments. Identify who can issue bonds. Classify debt instruments based on their maturity. Then I ask you to describe bond yields. Learn to describe the current yield and its calculation, and more importantly, yield to maturity of bonds. And differentiate between fixed-rate bonds and floating-rate bonds. Third, can you explore bond types and their features? Describe different types of bonds, callable, puttable, convertible, and understand the concept of bond seniority in the event of bankruptcy. When you're done, I ask you to answer these 3 questions. What is the primary distinguishing feature between bonds and equity? Calculate the current yield for a bond with a face value of 1,000, a coupon rate of 5%, and a market price of 950, with a time to maturity of 4 years. And describe what yield to maturity is. And, as an extra assignment, try and seek this bond's yield to maturity with a Google search for an online yield to maturity calculator. Describe the differences between callable, puttable, and convertible bonds. Remember that you can follow along using the PDF file enclosed. Regarding the markets for fixed income instruments, make sure you can identify market participants by listing and describing the roles of various participants in the fixed income markets. Understand trading mechanisms by comparing over-the-counter markets with electronic trading platforms and explaining how securities exchanges function in the context of fixed income securities. And analyze price determinants by describing how interest rates, creditworthiness, maturity, liquidity, market sentiment, and supply and demand affected the price of fixed income securities. Again, I ask you to answer 3 questions. What is the primary purpose of issuers participating in fixed income markets? Describe the role of brokers and dealers in the fixed income markets. And 3, explain how rising interest rates generally impact the value of existing fixed income securities. This might require additional and external research. Now, pause the video and get back when you want to check your answers. Now that you have gone through the practice opportunity, I can walk you through my solution. First, let's understand what sets bonds apart from equity instruments. Bonds involve periodic coupon payments and have a maturity date where the face value is redeemed. This makes them predictable and structured investments. Equity, on the other hand, represents ownership in a company and may pay dividends, but these are neither guaranteed nor periodic. Equity does not have a maturity date, meaning it doesn't have a predefined endpoint when investors get their principal back. Next, we dive into the concept of bond yields, which help investors gauge the returns they can expect from bonds. To calculate the current yield, annual coupon payment divided by current market price. Example, for a bond with a face value of 1,000, a coupon rate of 5%, and a market price of 950, the current yield is 50 divided by 950, approximately 5.26%. YTM, yield to maturity, definition. It's loosely defined as the return expected if the bond is held until it matures. It factors in the bond's current price, face value, coupon payments, and time remaining to maturity. Example, using an online YTM calculator, the approximate YTM for the bond described above is around 6.46%. Fixed-rate bonds. These pay a constant interest rate throughout the bond's life, providing predictable income. Floating-rate bonds. These have variable interest rates that adjust based on a market reference rate plus a fixed spread, offering protection against rising interest rates, for example. Section 3. Types of bonds. Understanding the types of bonds is important for selecting the right investment. Callable bonds. The issuer has the right to redeem the bond before maturity, usually at a premium price. Puttable bonds. The bondholder has the right to sell the bond back to the issuer before maturity, offering protection if interest rates rise. Convertible bonds. These can be converted into a predetermined number of shares of the issuing company's stock, combining features of debt and equity. Let's move on to the markets where these fixed income securities are traded. Market participants, issuers. You have governments, corporations, municipalities, and financial institutions raise capital through bonds for projects and expansion. Brokers and dealers. Brokers connect investors with sellers. Dealers hold inventories and trade on their own accounts, profiting from the bid-ask spread. Trading mechanisms. Over-the-counter OTC markets. These are decentralized markets where securities are traded directly between parties. Electronic trading platforms. These provide a digital marketplace for trading securities, offering more transparency and efficiency compared to OTC markets. Finally, we examine the factors influencing bond prices. Key determinants. Interest rates. Rising interest rates generally decrease the value of existing fixed income securities because new bonds offer higher yields. Creditworthiness, maturity, and liquidity. These factors also significantly impact bond prices, reflecting the risk and attractiveness of the bond. Market sentiment and supply and demand. These elements can cause price fluctuations based on investor behavior and market conditions. The explanations and the solutions to this practice activity are included in the accompanying notes that you may want to download if you haven't already. This wraps up for me here, and I'll see you in the next lesson about bond pricing.